The Midwest is doing okay, along with the rest of the U.S. economy, that according to a number of data sets, except the services sector, which is the largest part of the U.S. economy, still looking lackluster.
Well, it is, Angie. However, it came off a little bit, and there was a little bit of disappointment specifically in the employment subcomponent. But both the manufacturing and non-manufacturing ISM numbers showed, at least a steadying of the economy, and more importantly, ahead of the important Friday jobs number, both employment subcomponents were above 50, suggesting that employment continues to expand. We got confirmation of that, too, as well, within the ADP number. So really most focus will shift to Friday's payroll number, but the early read is employment continues to grow.
Continues to grow, but less than the average of the past year. Do you think it's still enough for maybe in 12 days the Fed to come together and say maybe June's the time for a liftoff?
I think it would take a real shocker, a real surprise number on Friday's non-farm payroll number, Angie, for the Fed to do that. I think we'd have to see a number, let's say, north of 300,000 and see the unemployment rate drop 0.2%. Make no doubt about it. I think the Fed would like to go. And I would raise an interesting theory with perhaps yourself and all your viewers, and that is this. We've seen some tremendous steepening of the U.S. Treasury yield curve recently. It's been trailing that. It's been following the trade in the bond market. And keep in mind that when the Fed does eventually get to raising rates, Angie, and we think they'll probably do it in September, they'd rather raise front-end rates when the curve is steep. For example, the 2s10s yield spread 175 makes a lot more sense to raise two-year yields than, let's say, when the yield spread's a little bit flatter, let's say around 125. So this sell-off we're seeing in bonds globally, both in bonds and treasuries, we think is actually a welcome event by Fed policymakers.
Well, I wanted to ask you about that because we saw U.S. stocks climb. Then we saw 10-year Treasury yields, go the opposite way there, at bonds falling, yields rising. So, I mean, in effect, what does this mean for the traditional market sense of things?
Well, there are a couple of things, and it's a great question. First of all, what bond yields globally, and let's just use bonds and treasuries as our benchmarks here, globally at the end of January, beginning part of February, were much, much, much too low. And they had priced in a rather depressing environment globally. And what we've seen in February and March out of Europe, and we're starting to see in early May in the United States, is that the data isn't as bad as the bond markets had priced in. So there's a repricing going on. Likewise, too, in equity space, specifically in the United States, S&Ps continue to find a pretty good base right around the 2100 level. And I think it's really important, Angie, to remember that there are other things going on in the world other than the obvious things, price of oil, economic data. And I would suggest to you this. There's research here in the United States going around today that perhaps a deal is going to get struck in Washington, D.C., where offshore profits are going to be taxed at a 14 to 15% rate from a current 35% rate. If that, in fact, happens, Angie, and the White House has been very coy and quiet about it, if that happens, large cap stocks are going to explode to the upside.